Can't wait to get started here. Oh, look at this. First comment. Kai's got the flight for Houston, man. Kai, where are you from? Very first comment. This is fantastic. He says the hotel is 30 miles from one airport and 26 from the other, so it looks dead in the middle. We got Jack from Japan. We got Seattle. We got all this stuff. We got Randolph. This is fantastic. We got Corey with Quick Start Lab #2.
Yes, indeed.
Awesome stuff. So Indiana, Ball State. Okay, let me tell you about Ball State, Eldon. Yeah, I know it's David Letterman, but that's Rick Majerus. Oh, I didn't read the whole thing. That's exactly right. My coach, Marquette, Ball State, Utah. Bam. Right there, man. That is really cool. Oh my gosh, that's awesome. All right. Cedar Hills, kind of close to my neck of the woods. We got Virginia, we got Oakland, we got North Carolina, we got Texas and Kentucky. See, in Texas, Cam is going to come. We had to get a block of rooms that was a little bigger. So if you haven't got your tickets for that event yet, some of you might not have been here last time, so I'll tell you about the event. It's pretty exciting, but we're running out of room. So Dubuque, Iowa had 9 inches of snow today. Matt, I lived in Clinton, Iowa, and I've been to Sebula. I've actually been up north to Dubuque. I've been to Dubuque, Iowa, Matt. I've been from Keokuk all the way up to Dubuque. I've been to Moline, Illinois. I've been to Muscatine. I've been to Davenport, Rock Island, all those places I've been. Canada is here, Palm Springs, Vegas is here. I can't get them all through, but wonderful. We have Corey Halliday here.
Excited as always.
We had a question about the VIX, and I think, Corey, that probably came from when the VIX is high, it's time to buy.
Yeah, a little bit of our discussion yesterday.
Are you muted, Corey?
Do I need anything else more on the whiteboard for Curie?
Hang on. I might just be talking to myself. Hang on, let's see.
Oh, can you not hear me?
There we go. Now you're there.
Okay.
Okay.
Can everyone else hear me? Hopefully they
can. How do we
can.
get a recording of this session? All Quick Start Labs are recorded for the last 7 years. And if you go to your Quick Start Lab section, just in the member site, I don't know how long it takes us to get those uploaded. I'll have to ask Mike that. But yeah, they are recorded. And so there we go. So Ryan says our audio is good. Corey, the VIX.
And Andy, do you write anything else on here besides Quick Start Lab #2?
I usually put like 2023, so we know what year it is. If we bring up makes it easier for the people that upload, but that's about it. We keep it pretty basic.
Very cool.
So Corey, we got a lot of things to talk about. We had someone ask about the VIX, and that's probably because last time we said when VIX is high, it's time to buy.
That's right.
When the VIX is low, it's time to go. And that's really a fancy way of saying what Warren Buffett said is be greedy when people are fearful and be fearful when people are greedy, because the VIX is the fear gauge. Do you have one? Do you have a chart of the VIX you can, there you go.
Yeah, let's take a look here. And maybe I'll put it on linear scale so you can kind of see the price differential here.
I will tell you this, a good way to think of the VIX, guys, is one of the great ways to understand risk is to study the insurance industry. And the metaphor, probably oversimplified, no metaphor is perfect. But for example, my son, since he has good grades, gets to drive a nice red sports car that goes from 0 to 60 in about 2 seconds. And it sounds beautiful. It's still a fossil fuel car, but when you start that baby up, you know what's going on. And the insurance, that dude wouldn't go over the speed limit if his life depended on it. I'm the one with the lead foot in the family, but the insurance companies don't know that. So they're going to charge him more. He does get a discount for good grades, but they're going to charge him more than, say, my wife, because he's a higher risk statistically, right?
Yep.
Statistically. And so the higher the risk, the higher the premium. High risk equals high premium. Corey's had cancer, I've had cancer, and it's awesome because when someone calls for insurance on the telemarketing, before they start their pitch, they go, oh, good, you have anything for cancer patients? And immediately you're click and they're done. So, they're out of here. So the higher the risk, the higher the premium. Well, all the VIX does is it looks at the options, on the S&P and says, hey, how much are people paying for protection right now? How much are they paying to handle volatility right now so they can have some insurance on it? And so the higher the VIX, the higher these premiums are, and that correlates to the fear, and that's why they call this the fear gauge. Anything else you want to say on that, Corey?
Now, that was a great explanation. And as you can imagine, the VIX moves opposite, inverse to the S&P, because when do people get most nervous? Well, when stocks are falling, and that's when they rush after protection. So if you look on this chart and you say, well, what were the two largest drops in the S&P 500? You'd say, well, back here in 2008, the global financial crisis. And you'd say, well, right here in 2020, around COVID was a huge drop, right? We actually traded a quick start lab through that March period, but the market fell about 40% there in a month. That's a huge drop. And those two large drops, well, wouldn't you know it, the VIX, its two largest spikes happen to be exactly inversely correlated. So when the stock market is going down, the VIX is going up, right? That's the tendency, because risk or fear tends to go up when the market's going down, right? If you think about a market going up, there's an old saying that the market takes the stairs up and the elevator down, right? When the market's going up.
The other one is the bulls go up the stairs and the bears jump out the window.
Yeah,
the other one that
exactly. And you think about like going up, that just kind of creates some complacency. There's not as much, when the market's going up, people just kind of feel complacent. Hey, my 401k, my IRA, everything seems to be fine. Usually in an upward moving market, the economy's good enough. There's, not all this panic, and people just aren't really paying a lot of attention to the markets themselves, right? When the market starts to crack, and when it really goes down in dramatic fashion, if we have a real crisis of sorts, well, this is when panic sets in, right? This is when everybody, people that don't normally follow the markets, they start going, well, what do I need to do? Do I need to go sell? Do I need to, and so that panic creates more selling in the markets, and the professionals go after insurance, and they're willing to pay super high premium. So these are crazy extremes. These are not normal. 2008 and 2020, that's not anything that's normal, but it kind of speaks to how dramatic those events were and how nervous and scared and fearful the market was during those periods of time. When you get a VIX that's up here in the 60s, 70s, 80s, all hell has broken loose, right? So
can you address this, Corey, just by way of comment? So why doesn't everybody just buy low and sell high? Why doesn't everybody just kind of say, like I've taught, for years, buy when they're cheap. You want to buy everything else in your life when you're cheap. Buy when it's cheap. Don't freak out. Look at, is Coca-Cola going to make it through the financial crisis? Yes. Is Coca-Cola going to make it through the pandemic? Yes. Is Coca-Cola going to endure through the next recession? Most likely. So why is it that everybody doesn't do this? Well, some people don't just, aren't content with compounding. Some people are really levered. And could you speak to that, Corey, that part of the reason people are going to load up on these options is it's one thing to have a stock go down and say, oh, that sucks, the price of my stock's going down, but hey, I still own the company and, still going to plug along. But if you're levered, and you're in danger of certain ratios and getting called, it's kind of like if a bank were to call your loan, wow. Could you speak to that on why these options are purchased and why people play the price game?
Yeah.
Wall Street, why do so many analysts on Wall Street get paid to put price targets on things rather than just where Buffett will tell us, hey, the most important thing is the operating earnings and fundamentals of the company. Why do all the analysts have to put price targets on things? Did you
Yeah,
speak to the levered nature of that? Is there
for
anything
sure.
else you want to say?
The nature of stocks is really that they're higher priced, higher cost, more amount of capital, right? So there's more capital. They require a larger amount of capital than does an option, right? Larger sums of capital. Um, the requirement on capital is high. With options, the requirement of capital to buy an option is very low. They require low amounts of capital. I could go out and buy 100 shares of stock in Apple, and it's going to cost me $15,000. I could go out and buy an option on Apple, it might cost me $500, right? So they're different requirements. That's part of what people will do is sometimes they'll get over leveraged in stocks. They'll be using, you know, uh, leverage in terms of margin, and it might be 1.2 or 1.5, meaning that whatever they have in their account, they're leveraging that up and going above and beyond. So if they have $100,000 at a 1.2 ratio, they'd own $120,000 worth of stock. At a 1.5, they'd own $150,000 worth of stock. They have a lot of stock, which leverage is always a double-edged sword, isn't it? It cuts for you and against you. When the market's climbing, having that leverage and they're looking at it and going, wow, I'm very profitable. But having that leverage really hurts you, especially in a big downturn, because now all of a sudden you're losing at a bigger rate, at a faster pace, and you are using someone else's money, the broker's money, in terms of margin. And so there can be liquidations. When a market is falling, a lot of the shares that are being sold are not so much shares that people want to sell, but they're forced to sell, either because they personally have too much pain, or because the broker says, hey, you're over leveraged, we got to liquidate. There's all sorts of examples, and Andy and I talked about this a little bit on the last Quick Start Lab, that leverage can be a bit dangerous with stocks, because now you're adding another person that could force you to liquidate, and if you get caught on the
Right.
wrong side of that leverage, then it could be a big problem. So one way to combat that, they would say, well, I have this over leveraged portfolio, but if I buy options to protect, well, if stocks are going down in value, at least my options are going up, and it creates less risk to me. And so even
Right.
though the options might be expensive, they'll come after them. They have to, they're forced to. There's an old saying when it comes to buying protection. The saying goes, buy protection when you can, not when you have to,
Yeah.
right? And a good way to think about that, an analogy would be a hurricane. If you don't have flood insurance and you live in Florida, and then all of a sudden a hurricane's at your doorstep, and you rush to the insurance company and you say, hey, I want flood insurance, quick, give me flood insurance. They'll say, it's about to flood. If you're going to buy that insurance, it's going to cost you a ton of money, because it's probably going to flood, right? This is where the insurance, the option premiums are sky high. I mean, 5 times, 10 times normal premium. So if this option would normally cost you $300, it might be costing you $1,800 or whatever. I mean, it's a really extreme example of sky high premiums, because there is, as they say, blood in the streets. Stocks are just crashing, they're collapsing, and people are in full panic mode. That's what these two examples show. The
So
biggest one more thing
go ahead,
about your
Corey.
specific question was, why don't people just pick the bottoms? You know, envy is probably the best way to explain that. Envy is a driving force for people because people don't like to see others make money without them, do they? And so people become envious of others in all sorts of ways. And in the financial markets, it's the same thing. Whatever's the latest, hottest area, like we saw this in crypto and NFTs. You can't tell me that most people thought that this little picture of, you know, an NFT was worth millions of dollars. Most of them aren't thinking it's worth millions. They're thinking these other people are making a ton of money and I want to make some of that money. It's pure envy. It's the greater fool theory of maybe I don't even believe in NFTs, but a lot of people got involved in them and started buying them or whatever because they were envious of others, you know. And
Right.
so
For
that
sure.
tends to be how the market participates in terms of the public. The public gets most invested in stocks based on envy. So a upward bull market will drive the average person to increase their stock ownership, to pile in, to chase the hottest craze, whatever. When the market's crashing, there's no envy to be had. It's all fear. And this is when the general public will panic out and say, what are we doing? This is stupid. The economy's collapsing, whatever. They're not doing it based on education or knowledge or risk to reward analysis or anything that way. It's pure envy that tends to drive them in on bull markets. And it's pure fear that drives them out of the market when it crashes. And if you
Right.
can flip those two emotions around and you can say, let's pay attention to when the public has lost their minds in terms of envy and be more a seller, you know, and more cautious up there. And then when the
Right.
market really cracks, that's when the opportunities, and you say, okay, when everyone else is in full panic mode, and it requires some real patience, but when everyone else is in panic, that's when I most want to participate as an investor.
Well, what we did last week or last session was we spent a lot of time developing our market opinion. And we said that, you know, Corey said, you know, I think we want to be neutral in this year's Quick Start Lab. And I said, I agree, maybe moderately bullish. I think the market might be optimistic about some Fed policy, but I think a sideways type of market is the one I want to make money on, which is really a cool market because almost everyone can think, okay, stocks go up, you make money. And almost everyone think, well, they've heard of shorting stocks and the Big Short movie and the Big Short book. But to make money where stocks don't go anywhere, that's foreign to most people. But as you look at this VIX, you know, and you have complacency, panic, even if you're sideways and something changes, we're going to enter some levered positions, more advanced type of trading. You know, the type of stuff where we really need, you know, to remember the disclaimer we always do, right? We have,
which, by the way, I think we skipped the disclaimer.
Education. Yeah, this is not the Quick Start Lab to quick the disclaimer, so we should probably bring it up before we start.
We better jump over and
yeah,
I'll pull one up.
We better do the disclaimer because our risk, you're going to see the risk reward ratio increase. We're going to have high risk, we're going to have moderate rewards, and high probabilities today. And there's the disclaimer. And basically what that says is all investing and trading is risky, and we're going to do some examples of risky. So be very, very careful. You know, it's the thing that, you know, I hate most about what I do. You know, like everyone has things they love about what they do and things they hate about what they do. And every couple of years, you know, I'll get a letter from someone that says, God, Andy, I know I screwed up. You know, I didn't paper trade, and I heard about something in the Mentor Club, and I thought, well, that's really neat, but I didn't do ultimate options or whatever. I just tried to hop right in with no paper trading, and you know, now I'm, you know, down in this trade, and you know, can you guys help me? And it sucks because we can't give advice. We can't say, well, you do this, that you can't. All you can do is educate by law, at least in my home country, the United States. And so it's really important to understand the emotions that are involved in what we're going to do, because the amount of reward that we're going to be seeing today is phenomenal. But so is the amount of risk. We're going to be very clear on the amount of risk that's there. And managing that risk, if you can go back to that VIX, managing that risk of a levered position, we definitely want to manage that thing early before these premiums spike and before the hurricane is at our door. And so what the way to prevent this is, if you're taking notes, we're going to give you some sage advice, and some of you some sage education, some wisdom, and we're going to remind some of you of some things that you perhaps got away from. I had a gentleman, great guy. He became suddenly unemployed, and he was so excited anyway, because he was, felt he was getting close to quitting his job, and he was in some high probability trades, and he didn't paper trade it, didn't take any real advance. He was doing advanced trading without any advanced classes or coaching or anything, no practice. And because the trades were high probability, killing it, 1 month, second month, third month, he's like, man, I'm retiring. This is awesome. And all of a sudden he had that 1 month where those probabilities didn't work in his favor, and boy, he really hurt himself. So please, please, please keep your temperament right. Keep it on paper. We're going to show you some fun things with, I think we're going to do Oxy, aren't we, Corey? Which Warren Buffett's probably going to buy that whole company eventually. But let's move off of the VIX and let's talk about our trade and just check in on it. It's only been a couple days. Let's check on the trade. Did you get filled on that by chance, Corey? Did I lose you?
Oh, yep. I went ahead and got filled on that. I did. So the stock actually gapped up next day, and I'll pull up this chart.
So it worked. It worked well for us, huh?
Yeah, it gapped up, which was the right idea, but that means that you're not going to collect as much credit, because we were doing a bull put. Remember the name, bullish. We were using puts, and we were getting paid a credit for this spread. And so that's the strategy. And we were looking at it right here, and the next day it gapped up. So instead of getting our 70 cents, I think we got 63 cents credit. So not quite as much, but the trade is working well. It's worth, basically we're up in the trade. We have some profit in it, but 63-cent credit. And I went ahead and put it on so that you could see this and we could track it here, because we highlighted this as an example trade. Now remember, our kind of theory here, our trade setup and our thesis, I guess, is that we were at the trend line. So if you look at this channel that it had kind of been in, we were at the bottom end of the range again. See how many times it's bounced, it's bounced, it's bounced, it's bounced, and we felt like we were going to bounce again, and sure enough, it bounced. Here's the top end of the range. Now, for educational purposes, we're going to show you how you can actually put on the opposite trade of what we did last time. So we did a bull put credit. Now we can do a bear call credit. And what that's going to do is create an iron condor. So it's going to take one. Yep. It's going to take one spread like that, add another one like this, and create that risk graph that creates the iron condor.
And I would just say that in truth, this is an educational trade, because there would be a temptation, at least for me, technical analysis wise, I would like to bump it. Like the higher this goes, the wider that risk graph's going to be in the profitability range. We're going to do it right now out of the immediacy of teaching, but I'd almost be tempted to see if it pops. We got if you look at the moving averages, we got some interesting convergences in those moving averages. I'd like to see it blow above those.
Yeah, and that kind of speaks to when all your moving averages are bunched together and they're all sideways. that kind of speaks to doing a sideways trade, in that
Yeah.
it kind of speaks to that this thing is kind of stuck in the mud, doesn't really know where it wants to go next. And so we put on a trade that said, we don't think it's going to go here. We're not even sure
Right.
where it's going to go, right? We didn't have to pick a direction. We could simply say, we just don't think it's going to go there. That's all we said. If it stays here, that's fine. If it goes up, that's great. If it goes down, that's fine, as long as it doesn't go down too far. So one way to think about that is, I call it the 5 directions. Those that have
Yeah.
been with me before have heard it before. The boy band, the 5 directions. When most people think of stocks and directional, they think bullish, bearish, or neutral. But I teach it a little different, in that the 5 directions really works like this. Here's your standard deviation. This is the 68% probability range of where you're likely to be. So here's a normal bullish move, here's a neutral move, and here's your normal bearish move. And this is where the stock's going to be 68% of the time statistically. And we can look that up. We can actually see that. We did that last time, and we'll do it more.
Yeah.
Statistically speaking, though, there's still the probability that you could have a more bullish move than the market was statistically saying was likely, or there could be a very bearish move. Now, those are only a 16% probability and a 16% probability, because that's what's left, right? Here's the 68% range. That leaves 16 left over for both sides. So we've essentially put on a trade here that says, if it does this, we're fine. If it does this, we're great. If it does this, we're great. If it does this, we're great. Uh-oh, we got a problem if this comes into play. That's essentially our strategy. So out of the boy band, the 5 directions, there's 4 of them that are singing here, and we're happy as can be. But one of those is going to be out of tune, and we're not going to be happy if that one plays out. So that's kind of the way to think about this from a statistical perspective.
Now, I had a couple of people say, I apologize, I must have turned my head while I was speaking. I have 2 screens, so someone said my mic was muffled. Is that a little better, Corey? Can you hear me all right?
Yeah, I think that sounds better for sure.
Okay, I'll try to get my radio voice on. Welcome to the Quick Start Lab, featuring Corey Halliday. Okay, try to do that deal. Let me share with you guys some wisdom, if I may, particularly if you're new. Even if you're not, you just can't be reminded of this enough. One of the challenges of the trade we're about to put on, and it's that way with any credit spread, is it gives you a lot of power. It gives you a lot of power for immediate gratification when it shouldn't. It's kind of a deceptive gratification. And the way this works is I get to make a lot of bold claims as a option investor. For example, I believe that option trading provides the fastest, quickest, most simple way to earn money, bar none, in the world, like fast as it can be. For example, if someone wants to have an income contest, market set go, I do a credit trade and I'm a click away from income. So it's really easy to get a dopamine hit when you click that button and money dumps in your account. Where this is a problem is that we often need to remind folks of why that is being paid up front. And it's because there is a transfer of risk that happens in that click. So while there's certainly an immediate reward, there's also an immediate risk. And so you can imagine like a $50,000 car, an average car. And someone signs on the dotted line, giving you insurance, and they're basically making you a promise saying, hey, if something happens to this $50,000 car, we'll pay for it. In that instance, as they collect that premium of a few $100s, they now are assuming a $50,000 risk of a car. They're getting paid up front to take risk. Excuse me, I'm fighting this cold like crazy. So just remember, in any credit spread, you're getting paid because of the net promises you've made. And you're getting paid for assuming risk, which is absolutely fine. After all, Warren Buffett does own a company called Geico Insurance, doesn't he? He's in the risk management business, and so are we. Well, the challenge with that is you have two sides of this trade. You actually have three. In fact, you could use a different colored pen, Corey, and maybe write this down somewhere. And I really hope that that you guys are taking a few notes. Is there's going to be three very important elements to the trade that we've done and the trade we're going to do. Number one is the reward. We absolutely need to know the reward. If you have a plan and a blueprint and you're getting rewards that are less than what you need to achieve your goals, then why even mess with it? Right? Why even mess with it? So many people get into something with no plan. I'm going to go buy crypto. Okay, what's your target? Well, I don't know. How much money are you going to make? I don't know. What's your risk reward ratio? So these are three keys to always have in mind every time you trade, whether it's cash flow or capital gain. The second thing I have to know is, okay, this reward is satisfactory to me. It can help bring me towards my goals. It's juicy enough to get my attention. I got to know the risk. So that'd be number two. And these should be finite. Okay, these should be finite. Now, let's stop right there with 2 out of 3. The position size you take, okay, the position size you take, what do you think, and you can type this in because it should be Captain States the obvious here. What should you consider when you think about the size of the position you're going to take here? Do you want to buy as many contracts to what you want for your reward, or do you buy contracts to risk? And you guys, before I even spit it out, you guys will always say yes, based on the risk, right? Risk. Okay, here's the problem. If someone is under duress, they had an employment change, or they have had, a health issue, or whatever it is, or they've lost a job, or what have you. And let's say a person needs to make $5,000 a month to barely survive, or 10, or whatever the number might be. There is a huge temptation to say, okay, I need $10,000 a month to get out of the rat race. Therefore, I want to make trades that give me $10,000 a month. That's not a compounding approach over time. And it doesn't allow the compounding to happen because you're not reinvesting gains, you're spending them. And it's not the approach that I like. And I love what Rui Albuquerque says here, Rui Albuquerque. I'm such a huge fan. I don't have many quotes. I'm not a quotable type of guy. Like if you go to AZ quote, there's no quotes from Andy. But one quote my sons know is I always tell them, always be bigger than your money. And that's great, Rui, because that's exactly, that's exactly what my son, he just says, Dad, always be bigger than our money. So I've drilled that into my boys. And so we want to position, so where you will get in trouble, a couple places you can get in trouble with this is when you try to look at it as a rat race escape early instead of later, where you don't reinvest rewards in compounding, but you spend them all, and therefore your nest egg isn't growing and compounding, and people become aggressive because think about it. If you have enough capital where you're one click away from being out of the rat race that month, that is a significant temptation because you think, man, I'm out, and it's a moral victory, and it's an exciting feeling. Take this job and shove it to your boss. So you got to realize that. Number 3.
And Andy, just one comment on that. So
please.
So for that person that says, well, I need 5,000 or I need 10,000,
right.
That's what I need to survive.
Yes.
The reality is they might not be able to get that yet from the financial markets.
Right.
The reality might be they just don't have enough capital yet to be able to generate that return. So they're going to be able to do what they can in the markets, and it might be $1,000. Well, you know, that's all your account will justify right now, because you can't take the risk to get that much reward. It just doesn't work for you yet. And so you got to find other ways to come up. You know, if you make 1,000 right now in the markets, well, you got to come up with another way to get the other 4. It might be a side job, or it might be whatever for now,
but certainly needed.
Yeah, and that's your point, is that just because we want a certain amount, well, you know, I would love it if the very first day I started trading, I started making $10,000. That's what I would have wanted, but I didn't have enough capital to make $10,000 every month when I first started out, right? And so it's a process of accumulating assets that will compound over time to help you to achieve those goals. But what you're going to find is that initially it might be 1,000, and then it grows to 2,000, then it grows to 3,000, and that's the process. Too many people want it to be a get rich quick. You know, they want their rewards today, and if they can't have it today, it's not worth the time and effort. And that's just a huge mistake, because obviously when you look at compounding, that what happens is it's later in the cycle that it just becomes overwhelmingly positive. When you look at Warren Buffett's growth and you look at the billions of dollars, he was doing just fine early on, but really it's in the later stages. If you go look at where he went from a hundreds millionaire to multi-billionaire, it was in the later years of that, right? And because he gave that money so much time to compound, he got to the billions. Well, we don't have that much time or maybe that much ability, but we can certainly get to the millions, the tens of millions. It's going to depend on how much time, how well you do in returns, and so on. But you can achieve some pretty lofty numbers if you give it time and rate of return and those inputs, right? So just because you want it to be a certain number, that the bad news is you might not be able to hit that number yet. The good news is that you can hit that number in time as you build up your asset column.
So let me talk about this. Let's put in the word probability, and then Ron LaFon had a good question. I'm going to hit that. You answered at the hint, but I think it's a really good thing we'll talk about maybe later on. So Ron, I'm going to get to your question at the end, but we're going to keep our momentum going here. So let's say the third number that we want to have that needs to be defined, and this is tough because, you know, we're prognosticating now, and it's a lot like the weather. You know, 60% chance of rain today or whatever. There's a lot of variables and things that can change, but it's really based on, you know, things like standard deviations and the history, where we're saying, look, we're going to say history often repeats itself, and when we see these certain metrics, well, there's probability. And the temptress here, right? The thing that gets us here is, let's say you have a probability of 80%. That will have the reward and only 20% get the risk, or even 90. There's a psychological and a temperamental, risk here, problem here, a little brain trickeration, where when someone says they're 90% sure, I think our brains sometimes have a hard time realizing that 90% is not 100%, or even 99% is 100%. And these mathematical realities are really important. On a roulette wheel, I don't know what someone who's like, you know, a savant could tell me this, like the Rain Man could tell me. But if I remember right, on a U.S. roulette wheel, I think they're different in Europe, but on a U.S. wheel, I think it's 1 to 36, isn't it?
Well, I think there's 30. Is there 38 because they got 30?
Well, yeah, it's 1 to 36 color.
Yeah.
So you've got 18 red, 18 black, and then you got 2 green.
Right.
Because you got 0 and double 0. So you got 2. And just when you play roulette, you know, you just think, my gosh, the chances of it getting, you know, you bet on black or you bet on red, and it's that 2 little green, Because, think about it. If Corey and I are playing roulette, he's always betting black and I'm always betting green, the casino is losing with one of us and gaining on one of us every single time, right? They're breaking even every time as long as Corey and I bet the same amount of money and bet opposite, because, they're basically just putting money between the two of us. But if it lands on green, Corey and I both lose and the casino wins. And that's the tiny little edge they need for the house. So
Yeah, the house must love it when they get a lot of people betting on the red and the black.
Red and green,
against each other.
or red and black, excuse me, red and black. And so even though that's the tiniest part, those probabilities are where you get beat, right? They're where you get taken down. And so we've got to have a plan. We have to identify all three of these. And then we have to say, okay, let's look at that 5-direction band and let's look at these check marks. And sometimes you can have an X on the top too, which we're going to do today. And we've got to have a what if scenario and a contingency that says, if this does not work out the way we think, what are we going to do about it? And that's why you paper trade until you lose in a paper trade account, to see how skilled you are in terms of your position size and in terms of your adjustment or exit from a trade, and how do you react when it comes up green, right? When the 00 roulette comes up and it wasn't what you thought. That's really the important thing. Jorge says, realistic, what type of compounding growth can I be proud of? For me, I'm only proud with the infinite. I want an infinite return. Anything less than infinite to me is not where it needs to be yet. So I like infinite return. I don't like 100%. I don't like 500%. I don't like 1,000%. I like infinite returns. And I've had investments that I've had to start out at 5% and work it up to infinity. I've had investments where I just get infinity right now out of the gate. So we'll talk a little bit more about that. Maybe we'll put that on the shelf. But an infinite return to me should be the standard that we're looking for all the time. Anything less than that, I'm not that proud of. But anyway, that's a good question, Jorge. And I'll talk maybe more about that too. So anyway, those three things need to be defined: risk, reward, probability. And then we're going to define a plan as we go through this trade. So let's double our money essentially from last time. And Corey, do you have a blank page?
Yeah, and so I'm going to kill this, but before we do, what we're going to do is we're going to take this check mark and we're going to turn it into an X, which means now we're going to reduce our probability, right?
Yeah, we're going to keep the same risk.
Down.
Same risk.
Well, what's interesting is our risk actually goes down, doesn't it? Because we get another credit, goes down a little, and our reward goes up.
Yeah.
And our risk doesn't go down much, but it goes down a little. Our reward goes up, and our probability goes down. So this is the trade-off. We're getting two benefits. We're getting more reward. We're reducing our risk, but here's the negative. Yep, we're taking now we're in the 68%. If this plays out, fantastic. We're happy as can be. But now we've created a bad scenario there, along with what we already had. So that's kind of an interesting. Let me pull up the whiteboard for you.
Yeah, I'm still trying to get my screen working here. This cockeyed thing is giving me grief, so I hope I don't lose everything. I downloaded the new, gosh darn it, I download these new upgrades and I don't know how to change stuff out of them. It's hilarious. So here we go. Stop mirroring. Maybe that will help me do it. It looks like it worked. Let me do this, Corey, if I may.
Take it over.
I'm going to see if I can. And I'm going to, and maybe what you can do is off screen on your screen, you can work some math and numbers for me, because I like to show this to everyone. And we're going to do a little bit of this in Houston. Well, we're going to do a lot more of it in Houston because we'll be there solid all day long for a couple of days. But let me find the way to share my screen, make myself the presenter with screen number 2, okay? And Corey, maybe you can do some math along with me just to, fly in support a little bit so I don't
Yep,
mess
will
this up.
do.
Okay, the first thing I'm gonna do is I'm gonna create a financial statement for person A. And this is, we're gonna do 2 pillars here. We've already did our fundamentals. We've done our technicals in the range and the moving averages and the consolidation, the stock opinion. We did all that last week. And we came up with Oxy. So how am I gonna make money in Oxy? I have asset, liability, income, expense, and I buy the stock. And does that pay a dividend? I don't remember.
It was a small dividend, around 1%.
Okay, beautiful.
Yeah.
So from a cash flow perspective, we're going to get 1% on our money without, counting any up or down in the stock. Just that's the dividend. So we buy the stock, get a dividend. Okay, great. Income, expenses, assets, liabilities, and perhaps some people say, hey, that's a bold claim that you can double people's income from their stocks, with education. Not really. If I have the stock and then I sell a call against it, now I get the dividend income at 1%, but I will also get a second income from the premium. So the 1% dividend is still intact, and give me just a rough ROI on a 4 to 6 week delta of maybe a probability of 80% or a little more than 80%, something like a 12 delta, 10 delta, something like that.
Yeah, the one we looked at, I think, was paying around a 1% premium right out of the gate, and it was about 5-6 weeks away.
So we'll
So
call that
1%.
1% a month. We'll round it up. I mean, we could take it down and just say, all right, maybe it's 10%, something like that. So now I've gone from 1% to 10, and to tell you the truth.
And to double their income wasn't hard at all. I mean,
no.
1% to increase their income from a 1% per year to a 2%, you could do that potentially in 1 month. So, not that every covered call is going to work out, but to double the income on this particular one wasn't super hard.
So here we could do something a little different. Here we could have some cash, and we could just make some promises to buy some things or promises to sell some things. And so we did what is called a bull put credit spread. So what we're going to do is we're going to sell a put, which means we've got to have some cash. And then we're going to take that cash that we got from selling the put, and we're going to buy another put, right, Corey?
Yep, buy that protective.
Yeah, buy that put. So the put that we sold, what did we get for that? Do you know that?
So let me pull up
combination
details here. It looks like we got 103 for the put that we sold.
Okay, so we received $1.03.
And then we we paid 40 cents for the option we
40
bought.
cents. So we got 63
cents.
And
Correct.
what were the strikes again between these two?
55 and 50.
So we have basically a $5. We have to have $5 in our account to do this, right? And we actually get to use, some of this money we received towards that. The 63 cents goes towards that. So in reality, it would be $4 and
37 cents, I guess.
But it's okay if I just leave it $5 for the math.
Yeah.
So let's do some math.
So when we talk in option terms, just for anyone that's new to options, because one option contract controls 100 shares of stock, when we say it's $5, that equates to, for one contract, that's a $500 position. So you'd need $500, and you'd collect $63 for a one contract position. Perfect.
So now we've gone to 12%. And this is actually not really 12%. See, why is this 10? Well, it's annualized. And so what we really need to do is 12 times 12 months is we're compounding at 144% of our money. So it's still not infinite, where I like to be, but we're heading in the right direction. So what's happening here is, I'll tell you what's happening with risk and reward right here. Your risk here is it's that someday the dividend might drop and the stock might drop. Well, that's the same risk you have here. It's no different. What we're doing is we're collecting more income by giving up some upside. So actually this is less risky, but less reward for doing this. So we're taking down our reward and taking down our risk, because we're going to take a bigger reward in terms of cash flow, but we have a ceiling now on how high this stock can go. So that's the trade-off. A bird in the hand, better than two in the bush. Over here, we're going, so can you see this trend of 1% to 11%? This is all annualized, right? 1% annually, 11% on average annually, maybe, and 144% if it all works out, right? If everything works out. If they stay strong and the dividend stays strong, well, it worked out, got 1%. If they cut the dividend, well, that's investing. Over here, if we get the covered call and it goes to the roof, we decide we want to buy it back. I mean, really, it doesn't matter up, down, or sideways. And, risks are lower here. And then this one, we took on some risk. And what was we said we had about an 80% chance of having that work out, we decided.
Yeah, it was a little bit, I think it ended up being just slightly higher than 80% probability. It was like at 82% or something like that.
What's Oxy at today? 60?
So it's gone up a little bit in the last
63?
couple of days. At 63.20 right now.
Okay, not to be confused with this 63-cent premium, just coincidental. We said that we are going to sell a put at this $55, and we're going to buy a put at this. So that's our $5 in risk. Okay. Now I don't know where these are going to be, but I'm just going to have some fun and say maybe we do this at we might go higher, but let's say we look at 70 and 75. And if we sold a call here and collected a premium of, let's say, $1, and then we bought one here for, let's say, 40 cents. So we get $1 and we lose 40 cents. We have another $5. So notice this, and this is where some of you that trade before get to be the smart guy in the class. So here my risk is $5, and here my risk is $5. So if I add that trade on, and I have $5 of risk added to, I start with $5 risk with this trade, and I add another $5 of risk to this trade, what's my total risk now? What's my total risk? Let's see who can figure it out. Well, some of you got the right idea. Some of you got to go savant on me. Some of you are like conceptually right. Okay, so the first thing we've got to realize is it can't be $10 because the stock can't be in both places at one time. I can only lose on one of them. If I'm in the middle of this, I win, right? I just keep everything. If the stock stays in this range, like Corey said, we have sideways is good, up a little is good, down a little is good, down a lot is bad, or up a lot is bad. And now we get to trade a range rather than a direction, which is so nice to do. So actually, if I get 60 cents on the top and 63 cents on the bottom, that's $1.23. And then it's $5, that means my risk is $3 and what, 77 cents is my total risk?
Yep.
Is that right?
Yep.
And so, and I don't know that this math's gonna work out perfectly here, but now I have a balance sheet where I'm collecting $1.23. So let's bring this back over here. On this one, I'd be collecting $1.23, whoops, $1.23 divided by, what did I say, 377? Is that right, Corey? You always got to double check.
377.
And that's going to be 32%. This is about a 1 month trade, so we'll annualize that. And now we're compounding at 391%. And so we go from 1 to 11 to 144 to 399. And in this case, our reward went up, as Corey said, our risk went down from 5 to 377, but our probabilities now are going to be tighter because now we have a problem on the upside where we didn't before. We could go through the roof. Now we have a less of a probability. So I just want to come back to this and say, hey, when you can demand when you can put 377 in your account, demand $1.23 out of it, that's kind of a juicy, exciting, compounding. You put that in a compounding calculator, it can be unhealthy to do that because we're not considering, we got to consider that, this risk is very real. So I don't know that we'll get that good. We probably won't get that good of a premium. It's just an example. But can you guys see the importance of not being emotional about this and the importance of good position sizing? Because if you're right, you get $1.23. But man, when you're wrong, it's kicking our butt here. That's a lot to risk and lose. And so we don't want to lose that right there. Okay. Really, really important. You guys,
and you can see how on this that you doubled your reward like we had talked about. So your reward actually went up, which reduced the max risk. Before we were at $4 and what was it, 437 of max risk or something like that. Now it's down to 377. So we added some reward, we reduced some risk, but the probability is where we now have another direction, one more of those 5 directions that can hurt us. Before we had 4 directions that we were happy with. Now we only have 3. So we're giving something up. That's the thing about the markets. There's always trade-offs, right? Yeah. If I want this, then I have to give something over here. So if I want more reward and more premium coming in and double my premium, well, I'm going to have to give up something. People don't just hand you money for free, right?
Yeah.
So I had to add a new element of risk, which is too much upside, and now I can lose. Whereas before, it wouldn't have hurt us.
Brandon asked a good question. He says, what if, so I'm in trouble here, I'm in trouble here. What if it stays in here? Well, all of these would expire. What have I promised to do here? Well, I promised to buy at 70. Or excuse me, I promised to sell at 70. Well, and here I promised to buy at 55. So no one's going to make me keep these promises if it's below here on the call and above here on the put. I have to keep the promises. In fact, if this is at 63 and someone wants to sell it to me at 55, great, I'll take it, right? No problem. And if this is 63 and someone wants me to sell it at 70, I'll buy it right now and keep that promise. So this money just gets kept. So if I can get a nice, 70 to 80 to 90% probability in here, I can just let this stock meander, and next thing you know, we do it again the next month. It's our planning, and we're hoping it'll go up here so we can kind of show you what you do if it goes above here. And there's a myriad of things we can do. But before we get to that part, let's just get a trade on and get this metric. I think that Sean Stone, I really like Sean's question right here. Sean, I'm not going to go into the details of it. He says, hey, do you want your IRA to be greater than the delta time to strike or the strike spread? And what I really want, and that's just a rule of thumb criteria, right? And it really doesn't matter. I care more that you have a criteria than what your criteria is probably. I care more that you have an exit and a hedge, because there's all kind of different criteria you could have. And it's not just the delta and the strikes and the spreads and the ROI. It's also the technical analysis. What does the chart look like? And, other things like that. But for now, what I'm hoping is everyone is getting a better understanding of this, is that in the cash flow pillar, we have this Oxy, and we say, how are we going to use this? Am I going to use it at this level? Am I going to use it at this level? I'm going to use it at this level. I'm going to try and go for something like this. And we can go even bigger. I mean, there's trades we can do that are even bigger. More to manage, more education, more to know, more risk you're taking, right? So with that, let me give it back to Corey. Was that helpful? Who got something out of that? Say, I got something out of that. So I know we're teaching well. And so since we're neutral, like for example, in COVID, we did a lot of directional stuff because the world was falling apart, right? It's pretty simple to do. Right now, we're not doing a lot of directional stuff. We're going to do some neutral stuff. And we're going to look at the risk graph here and see what we can do. So Corey, take it away.
Yeah, so this is,
we'll find a strike that we like on the top side, and let's do an iron condor.
yeah, so this is kind of fun. Again, a recap of the risk graph. Remember, we have the 55-50 put spread down here. So some key levels, if I just kind of grab this box, so this line here, you can see where the stock is at up here. You can see that we're all the way down here in terms of where we don't want it to be. And anything above this level, you'll see that that profit just it stays the same. We're up our, credit received. Since we did 5 contracts of this, we collected $63. Let me pull up a calculator. $63 times 5, that's 315 bucks total. And we make that 315 no matter how high it goes. Now you're going to see this risk graph change in a minute, but I want you to see that right now, stocks here, if it goes sideways, we're great. If it goes down a little, we're great. If it goes up a little, we're great. If it goes up a lot, we're great. If it goes down a lot, that's where we have a problem. But we're going to change this by adding a new element. So if we come over to March and we say the stock's at 63, what we're really doing with this strategy is saying, where won't the stock be? Again, where won't it be? And look at how good Andy is. I'm thoroughly impressed. Look at what the 70 strike call is going for. Remember he said it maybe about $1. Look at what the 75 strike is going for. Remember he said about 40 cents.
Let's not, hang on. Let's not give Andy any credit for getting lucky, okay?
Well, you've looked at enough option chains and you knew it was 7 points out of the money and were able to make an educated guesstimate. That's pretty impressive. So we're going to collect a little over $1 and we're going to pay probably a little less than 40 cents, but pretty close to what he was analyzing there if we did those particular strikes. And why not? This is for educational purposes. Let's go ahead and build this. So what I'm going to do actually,
and we might,
I'm going to build it as a spread.
And the thing that kind of makes me nervous about this in aggression is that 23 delta. We're not going to quite, this will be an educational purpose trade. It's a little narrow for my taste. When we look at these put together, it is a little narrow for my taste. So what we really want to look at is, we'll go back to the chart now. And I would feel better about this because this is a slightly aggressive. I would feel better if I found some resistance somewhere in that chart that it'd be nice to have it out of its normal range. It's not going to make it there, but we do have some resistance at about 68. It looks like 67-ish. So we'll see. That we'll see if that can hold up, but. We might. I kind of like the aggression, Corey, because the thing is, we haven't had a losing trade in the Quick Start Lab I mean, I can't truly remember the last one we had.
Yeah, it's funny. We discussed this and we were like, we really need one to go against us so we can show more.
So we can teach better. Exactly. So I think, I mean, well, let's everyone decide here. Okay, we'll take a vote. What we can do here is we can go, oh, look at this. Martin says he's starting to have a little epiphany going here. So the other thing is that this is really important. Stephen Collins makes a pretty good he makes a good call here. We're going to get to this. Narrow meaning delta is high. Yeah, Daniel, that's exactly right. We want these as wide as we can get. So there's a couple things we could do here. We're going to take a vote. We can wait on this trade a little bit and see if that pops up a little, and then we could maybe wind up selling this at 78, 75, something higher. We could wait. We could just say, let's do this for education purposes and maybe get ourselves in trouble so we can see if we can get ourselves out, which is the kind of what I'm inclined to do. Or we can, just say, hey, let's do the smartest trade possible. I want to see what the smartest trade possible is, so we can, try to bat 1,000. But we've been batting 1,000 in so many of these. I'm inclined, like, don't copy this trade in your own account, because we're going to show you what it looks like to take more risk, maybe, and it may work out, it may not. So, do we want to play it safe, or do you want to learn it? Should we get into a little trouble and learn it? Okay. All right. So we got it right in. So we got it right down the middle. Someone's going to show us like what real life might look like. Well, like I said at the very beginning of this trade, when I saw it pop up, like it's got that little hammer, type of it's got what this is called a hammer 4 days ago, right, Corey? Kind of a hammer type of or a dragonfly doji, you could almost call it. And that's often a signal. And then we have this huge bullish, it's not quite, it's almost like a Marubozu. Would you call that a Marubozu? I would.
That's yeah, pretty much. A Marubozu is basically finishes right on the highs and not really wick.
It's really doesn't have an upper wick. Marubozu, I've heard in Japanese, means crew cut. We cut the top of his hair off, so we have a wick on the top. Little pullback in the next couple of days, but if this could pop, that's what real life would look like to me, Jorge. I'd probably wait on the upper and widen this, but it looks like most people, the bigger vote is to say that someone wants to do both. That'll complicate everybody.
Yeah.
I think most people want to get into trouble.
Most of them are voting for that for sure. And here's maybe a good way to kind of show you that we've been trying to get into a little bit of trouble. Let me explain. So here's where the stock was. Let me change my color here. Here's where the stock was when we were analyzing the first trade a couple of days ago, right? It hadn't popped up. Look at, even with the stock having gone higher, look at where its probability of expiring cone is at the expiration we're trading. So this is just a little something that basically shows you what I talked about, the standard deviation, the 68% probability range. Now remember, when it was right here, this probability cone goes off of the close. It goes off of where the stock is at right now. So this probability cone would have looked a little different 3 or 4 days ago. It would have been something like this.
Yeah.
But this is fine. We'll just look at the current one. Here's the current probability cone at this exact moment. And they say, okay, statistically, from where it's at right here, based on its historical volatility, and it has an earnings announcement coming up, all these things built in, here's where it's statistically likely to be. What we traded was the 55 put and the 50 put. And what we're talking about trading is the 70 call and the 75 call. Does anyone see a problem with that in terms of probability? Is that we're basically inside of the probability range. We're not outside of it, right? If we really wanted to be safe and careful, wouldn't we have selected strikes that were down here?
And we could have done that, because
absolutely.
Annualized, we're at 144% already. We don't need that. And if we throw this one on, we're analyzed about 300%. We don't need that much. So we can always go further and play it safer, but we'll get less reward. But I'm inclined to put, so Jorge, you said, what would real life look like? That'd be it. And it would significantly drop, but it's still going to be better than the covered call, for sure, in terms of ROI. And so there you have it. It's really, and another thing, a guy like Noah would go narrower, because he's so confident in his ability to trade adjust it. And maybe we take a smaller position size. So this is where you get to decide what you want to do based on your goals. When I write these really wide. Why? Because I'm inherently lazy. That's why. I'd rather take less money and, not have to work at this. The narrower I get, the more likely it is I'm gonna have to make an adjustment, do some stuff, blah, blah, blah. But I get a lot more reward for that work I'm willing to do. So let's write it. Okay.
Yeah. So if we come over, we're gonna be looking at that 70-75 that Andy, like Nostradamus or something, those out there. So we're gonna.
Guy gets lucky guessing one strike and one premium. He's gonna try and make me look good when I'm totally guessing on that crap.
So Andy, I mean, you nailed it. We got to give you credit where credit's due here. So 70-75 call
spread. I get credit. Well, okay, let me tell you this, guys.
65-cent credit at the midpoint.
Look, Corey's trying to make me smart, but look, all you really had to do is look at what the puts were. Usually the calls were less, but all you had to do is look at what the puts were and say, oh, I'll go up the same distance from where we are today and use the same number. So let's not act like I was a genius there. I basically just took the bottom and went up about as far on the top as we did the bottom and used the same number. So I don't want anyone to think I'm a genius there. That was pretty simple to do. In other words, that's not a stupid human trick.
Yeah. Okay. So here we've got the March 70-75, which again, like he was saying, I mean, we had done the put spread, which is about 8 points out of the money. That means stock's at 63. It can fall 8 points before it gets to 55 and we get in trouble down there. We're giving it about the same distance this way, and we're picking up about the same credit. You see that? So if we analyze this, let's just analyze this trade. Now I'm going to start by taking off the put side. We're going to eliminate the other trade we have on for a minute.
Take off the risk graph on that side too. You can open up your price slice. Corey uses Interactive Brokers, so I'm gonna say go to the left. Go to the left, and on your left it says price slices, right down about 2 inches left, and open up those price slices. Okay, now how come there's two? Oh, you got rid of it anyway. Okay.
I nuked them. So so we've got basically, in terms of this trade,
80%.
We've got on this side of it at the break even, again, we've got about a 20% chance it's on this side of the break even, which means there's an 80% chance we're on the good side, right?
Let's quiz everybody. Okay. We said you needed 3 things. You need to know the risk, you need to know the reward, and you need to know the probability. So let's see if you can type in, just put in, risk is blank, reward is blank, probability is blank of success. So see if you can identify all 3 of those before we do this. Someone's asking for an Interactive Brokers Quick Start Lab. We could do that. Okay, so look at the risk graph and kind of get you could actually do the actual math if you have if you have a $5 spread, 70-75. So certainly if you're going to be forced to sell at 70 and buy at 75, obviously if I'm buying at 70 and selling at 75, that's obviously buying at 70 and 75 and selling at 70, that's obviously a $5 loss, offset by a 65-cent credit. So that's $4 and 40 or 35 cents.
35, yeah.
$4.35 risk. Okay, let's see if anyone had that in there. Okay, pretty good. My reward is $65 or 65 cents. And my probability is 80%, it's 79.93%. So now I have those 3 metrics, and I can kind of think about that for a minute and say, gee, 80%, dang man, that means if I do this trade 10 times, I'm going to lose $4 twice, and I'm only going to make 65 cents 8 times. Well, let's get our calculator out and do that math. What is 8? Let's do 10 trades on this. And this is where it's so important to understand that roulette wheel and those, you know, like, oh, that's an 80% chance of success. That's awesome. The brain kind of makes that more exciting than it should be, maybe. And if I say, all right, 65, and I do that, let's say 10 trades in a row, well, I'm going to make $6, right? $6.50. But
Well, do we want to say 8 times? 8 times out of 10, we make 65.
Oh yeah, thank you. 8 times out of 10. So 8 times 65 cents is what, $5.20.
$5.20. Yep.
But in the 2 times I get it wrong, I gotta go 435 times 2. That's $8.70. So, you know, I'm gonna get all that 8 months of work wiped out in that 2 months and still be like way behind, right? Way behind the 8 ball, right? In fact, I'd have a total loss of $350 for the year. And so this is set up to lose. This is really important for everyone. And you know, I always tell people, I always tell people, we try to give our, like, when I put people in the 30-day cash flow blueprint, you know, we basically have them break it down if they're, you know, financially struggling into about 160 some odd dollars a month for education. And we think that's pretty smart, because if a person's going to buy $10,000 worth of Apple, having $100, you know, each month of learning is probably not a bad idea. And yet other people will not do that. They'll say, well, I'm going to save the $100 a month and whatever. And it breaks my heart. People don't realize that this is a losing strategy if you don't know how to manage the risk. The only way you can, I mean, if you run the roulette wheel right now and you do this trade for the next, you know, year, you're going to lose $350. If you do it for the next 10 years, you're going to lose, you know, $3,500. And if you do the next 100 years, you're going to lose 35 grand. It's just how the numbers work. They're working against you. The only way to make this iron condor work, the only way to do it is to understand trade adjustment and to attack this trade in the 2 times, the 20% of the time where it goes bad. Knowing what to do in that 20% of the time it goes bad is the X factor in turning the strategy into a profitable strategy and the opportunity to profit for it more than you would have a loss. So I just want very badly to understand this. It's really, really important. You know, Andrew has an interesting question. We've got some guys with interactive brokers, and maybe we can show them how to do this. Like, let's check in next week and show them how to do this on that software, because it is replicatable for sure, no question. And you know, sometimes when you buy a Chevy, the windshield wiper handle is in a different place than a Ford, right? Or the cruise control is on the steering wheel instead of on the steering column. So have no fear. Have no fear. We can show you guys how to do that. That's what we're here to do. But the bigger point I want to drive home, okay, the bigger point I want to drive home is, everybody, do you understand how important it is to like, can you see how people blow up their account by position sizing to the reward of 65 cents rather position sizing to the risk of 435, and also without the knowledge of it's the green spots on the roulette wheel you got to worry about. It's that 20%. So 80% of the time we don't worry about the trade, but 20% of the time we definitely do. And it's that 20% that separates the children from the adults. Do you guys get that? Yes? Yeah, Monster, very good, Daniel. I see someone, Daniel has taken Ultimate Options because he's using the right language.
He's using our language, yep.
Yep, yeah, very,
and
very
we teach
important.
that in Ultimate Options. I mean, certainly there are critical elements missing here in terms of
Yeah.
the management of these. And that's what Daniel's referring to with, yes, the monster got too big. We need to basically create
Yes.
an offset, a hedge, a protective position as needed, because these trades can and will statistically at times go against you, right? There's
Yes.
just no way to have 100% success rate. There are some
You'll need to
occurrences that
graduate.
will, you have to know how to make those hedges. Absolutely.
So let's put on the other side of this trade, click it back on and see how it reduces the probability.
So let me jump over here and we're going to click those back on. And now look at this. So now we've got both trades on. We've got our original position. Yep. We can set slices. We'll go to break even.
Yep.
At expiration. So if you look at this structuring, here's a break even, here's a break even. You can see that we've got about a 66% probability of being inside of that and being profitable.
This is a huge risk to reward though, man. I mean,
yeah,
this is much narrower. What's your rule of thumb on an iron condor, Corey? Like right now we're looking at about a $600 reward, I would imagine. I can't do the math in my head. And maybe a $1,800 risk. Yeah, about a $640 reward and a risk of I mean, that's 30% on your money, isn't that?
Yeah,
Am I right on that?
Yeah, exactly. We've got, so if you look at the numbers, because we're doing 5 contracts here,
yeah.
But basically the reward ends up being, remember we collected 63 cents for the first one, and we're collecting 65 cents for the new one. Whoops. So that plus that is our reward. If we do one contract, that's times 100, that's $128. We're doing 5 contracts,
which is
so we get $128 times 5. See this 640 that we just calculated is our reward? You can see it down here. Watch.
And this is the problem. This is a problem. This is a problem because someone's going to say, "Oh, I just lost my job. I have a $640 a month car payment.
Yeah.
And I have $1,800 in the bank. Oh, I'll just take my $1,800 in the bank and pay my car payment for the next 8 months, right?" And that's where they get in trouble because we're position sizing to a $640 bill rather than saying, no, I'm going to take this $640 and reinvest it. And then on the days where it doesn't work out for me, it's fine because I don't need that money. I can make an adjustment. I can even take a small loss once in a while and still become profitable over the year.
Yeah.
Very important to have the right mentality if you can do these. Very important.
Yeah. And we're showing a little different numbers just to give you experience, but obviously start with 1, in your paper trade. And then over time, go up to 2 over time and so on. And it would be the same process in live trading. You certainly wouldn't jump out of the gates and trade with 5. So in your demo trading, start with 1 and make the calculations easier. It's just, hey, that's just $63. This is $65. I don't even need to multiply that times 5.
Yeah.
Make it a little easier. And then if you look at your max risk out here, like we said, it's $1,860. See it? At expiration, if the stock is at 50 or below.
That's 34% on your money. Now, what do you like to see on these? That's much more aggressive than what I would ever do. So we're going to try and get ourselves in trouble, which I would love to do. Then we can have to get ourselves out.
Yeah, usually I would have, this side more like probably out in here, where it's outside of the 16%, and this side out here somewhere
if I
where I'd be putting them on.
Return, if I see a 10% return and a 90% reward or probability, that's pretty much irresistible for me. If I get a 10% return on my money in about a month, 6 weeks or less, and I can get 90% probability, it's irresistible. So I'm much more conservative because I even feel like 90% probability is very aggressive. And 10% on your money, that's 120% a year annualized. That's ridiculous. It's awesome. But I agree with you, Corey. I mean, you're a better manager than I do in terms of you just think faster, and you're less lazy than me. But yeah.
Miranda has a great question. Is this naked or covered? This is covered. Both options are covered. Nothing is naked. See, we bought the protective call at 75 to protect our short. We're certainly collecting more for this than we paid for our reinsurance. And same thing over here. We sold this one, but we bought these as protection. And that's what creates this effect. This going that way and this going that way. That's why our losses are capped. See, we don't lose in a.
We keep every promise we made because of two things. Number one, we have a little bit of cash, and we can actually, wind up buying at one price and selling at the other because we can play both sides. For every promise they make us keep, we have an option where someone else has to keep a promise. If that makes sense.
Yep. So we made a promise here. We bought the rights to do something here to basically insure this trade. So we sold insurance and then we bought a reinsurance policy just to protect our downside. We sold insurance, collecting a bigger premium. We went out and bought some reinsurance here just to make sure that we were protected.
Sean is killing me. Sean is killing me. First of all, can I read, Sean, is it cool if I read what you wrote? He goes, this is ironic. I actually just did lose my job today. Now this is killing me. Excuse me for the cold.
Such a good attitude.
I did lose my job today, but no, I'm not going to make any Colorado grade weed decisions. And then he says he works in IT. It's not his first rodeo, and I can tell he's got a pretty good attitude. Often getting laid off is the best thing that ever happens because you always get a new opportunity that's even better. So that's congratulations for having a new opportunity.
Yeah, and let me tell you something else on this trade that's a little piece of good news. So look at this as follows. If I set these price slices back to break even, here's our break even and here's our break even. And when we're looking at our losses, it's really, here's a little sliver of good news. We're not taking a max loss as soon as it's below that. So our probability of a max loss is not actually 18% or 15%. If we truly wanted to get to our max loss number, you'd see that it's less likely and less likely, right? Those are the max loss levels. So we really have about a 16% chance on this entire trade of ending up at a max loss, about a 10% chance that this one would end up at a max loss and about a 6% chance on this side. So that's a little piece of good news is if you finish between the strikes, you're not at max loss. You might have a little bit of profit, not the full profit, but a bit of profit, or you might have a little loss, or it might start to get a little bit bigger loss and a little bit bigger loss and a little bit bigger loss and then max loss. But finishing in between the strikes is either a little less reward or a little less risk. It's not a max risk. And same thing over here. We can make a little, not the full amount, but a little, or we start to lose a little, start to lose a little more than that, start to lose a little more than that, and eventually end up at our max risk down here. So that's a little piece of good news as well about these trades is just because your loss level is right here, that's where you start to lose, and the probability of starting to lose is 18%. There is a little piece of good news that, well, our worst case scenario only has 10%. There's, an 8% chance we could finish in between those. So that's something to be aware of.
I have to compliment. I'm loving this. I'm having a ball because the questions By the way, I suck at typing, guys, so I'm trying to go as fast as I can. Will be the same. You guys have great questions. Can I just highlight a couple of the questions real quick? Question number one, would entering wider strikes, in that 90% probably change, would that change, would the odds of getting filled go down? It depends on it depends on the options. The further out you go, usually the less volume there is. The further out you go from the money, less volume there is. But we wouldn't be going out that much further. We would get, like, if we want to choose a 90% probably instead of 66, we're going to get filled. We're going to get filled. If the quotes are there, the reason the quotes are there is because those options are being traded at those premiums. So while the volume might be down, it wouldn't matter, because if you're getting the quote, then you're probably, have bid and ask on each option that's going to get filled. So
Yeah.
Great question by Wade.
And can I add one thing to that, Andy?
Yeah, please
When
do.
you talked about the three things that we need, the three elements, reward, risk, and probability,
Right.
you said something there, which was we need to make sure that there's at least enough reward to make it worth our while.
Right.
Like, you could theoretically go way up here and sell an option way up here, but there's no reward in it. You'd collect like 50 cents, literally,
probability,
or $1 to make a dollar, like literally $1 is
Right.
all you can make. It's just not even worth doing, right? And especially if you have to pay a little commission of 65 cents for the contract, you end up netting out 35 cents a price. Like, there's just no reward. And so you could go theoretically so far out. And if you look at the options, you'll kind of see it, where we start to get to a point where at some level, we're not even interested in these because there's just no value in it.
Yeah,
See, what we're selling here has some value, but if we get all the way out here into the 80s, I mean, what are we going to do? Sell this one for 6 cents? That's $6. Buy this one for $4, and we make
2 cents.
we make $2 total. It's just not even
on a $500 risk.
Exactly. And so, no, thank you. We're not gonna do anything that pays us $2 total of profit, And so you have to make sure that the total money amount
if you
is
look
worth
at that, if you look at the 4 delta, well, that's $15, and the 3 delta is like $9. So that's a little different, right?
Yeah.
So,
yeah. As long as you get, enough premium, it doesn't have to be like we're a little high on the premium, because we looked at those numbers and it's a big amount. But I could see doing some of these out here potentially, right, where you're collecting
for sure
30 cents on this side and 20 cents, or I'm too close there, 20 cents over here, and net you bring in 50 cents. You got 450 at risk. This is $50. You're not collecting $2 of profit. You're getting $50 of profit for 450 of risk. Something like that is more reasonable. But I'm not going to do anything for $1 or $2 total. So
another great question. I got to find out where this was. Robert Ellingsworth has a great question. He says, is it easier to make adjustments if you purchase the single or the 4 contracts versus just singles? And the fact of the matter is, I don't want to bore everyone with a story, but no matter whether you select to, like, you can go up where it says add simulated trades, and you can do this up one more, Corey, there you go. And then you can go to, what I think is it? See where it says spread, option chain, filter off, single. Oh, down, right. Oh, right at the top of the option chain. Go right, it's directly, there you go. You could actually say, see where it says Iron Condor? You could actually put one of these on. Now, if you open up the options chain to March, there's the whole Condor. You got all 4 right there. See that, Robert? So we could actually tweak this and make it one trade. we couldn't do that in ours because we put on one leg first. So now we're putting on the second leg second. But if you want to start the trade with all four in one click, you can do that. You could also do it in 4 trades. Boom, boom, boom. But it doesn't really matter whether you do them all at the same time, whether you do 2 last week and 2 tonight, or whether you do all 4 individual. The commissions will be the same. The promises will be the same. The options choices will be the same. It really doesn't matter. I will tell you guys a little story here, if you can endure one. If you guys can endure like a 2-minute here. Years and years ago, when I was teaching on this, doing it, there was an old brokerage called Daytech. And Daytech doesn't exist anymore. And this was back in the days where when you got on the internet, your phone made noises. So about half the group here doesn't even know what the hell I'm talking about. There was a time where you literally plugged your computer into a telephone line and the internet went over the telephone line. So you just unplug your phone if you had an older home, and you plug in your computer with a phone jack. And they go, made all these noises. Anyone who's old and remembers that crowd? Does anyone remember those days? So Daytech was like a pioneer in trading. And if you isolate, like, I think it was, who asked the naked question earlier? Are we covered or naked? Who said that?
It was, who was it that asked that? Let me look here. Is it Kate? No,
Someone
Miranda.
asked if we were naked or covered.
Miranda did.
Miranda. Well, if the computer can see it as an iron condor and build a risk graph, we know it's not naked because the risk is limited. But in the old days, Daytech didn't have that technology. They couldn't do it. And so they actually would think your naked call leg, in this case, we're looking at it right here, and it's the short, it's the $70 call. Without that 75 long call, that 70 strike short call would be naked. And so the computer would freak out, and it would tell people, oh, you're taking too much risk for the size of your account. And this guy was a fairly advanced trader, not great. There's this dude trading, he had a multi-million-dollar account, and he would trade these with millions of dollars. And he'd call Daytech every day. He'd put one of these on. Every day he'd call them, and they'd do the math by hand with a manager at the trading desk. And he'd reset the computer to say, he's okay. He's not going to put our brokerage out of business because he has the long call. He has, like in this case, okay, he has a 75 call. He's only got a $5 risk. But the computer just saw that, the computer would say, okay, this one has a $75 risk and this one has an unlimited risk. And so put them together, it's only a $5 risk. And so they do this by hand, and the guy would reset his account so it wouldn't, make a red flag and freeze it. Well, all of a sudden we have the subprime meltdown. So how many years ago is that? 2008-ish. So what is that? Like 15 years ago this was? Am I got my years right? So about 15 years ago, no. Was it the .com bust? I can't remember which one it was, but it was one of the busts. And it must have been before because the internet was so new.
Yeah.
But anyway, whatever one it was, whatever one it was old, and Daytech sucked and all this stuff. And I didn't even know the guy, but we had a mutual friend, and one day Daytech calls him up, and the market's just crashing, and he can't get in. He's locked out of his account. It's frozen until he does a margin call, until he puts in a ton of money. Well, he's got all his other money in real estate. He didn't have, millions of dollars just write a check. And he calls the guy to get it unfrozen because he's got to make adjustments, right? He's got to make adjustments. And he says, man, I need to talk to, Steve or whoever. And they go, oh, he quit. And he's got almost like the level of an intern. And this young lady, the call is recorded, and she says, look, sir, and she didn't understand the trade. She couldn't have written an iron condor. So that's what's crazy. There's people that work there. In fact, if you have a problem with one of these, you call Ameritrade, there's a real chance that the lower level advisor won't know what you're talking about. Let's say, let me get you someone from the options desk. And even in the options desk, that you can tell when you talk to them, there's different levels of intelligence. I've talked to some guys at the option desk who are just freaking studs, and others are like, okay, is this your first day? But anyway, this sweet lady, young lady, she says, sorry, sir, all I know is the computer says you're over your margin. I can't unfreeze you. I'll lose my job. He goes, I'm going to sue you, blah, blah, blah. They fight. And sure enough, they don't unfreeze it. So he's going to sue him, and he lost $6.9 million over this thing. So he's lost $7 million. And he's whining to his friend about it, and his attorneys don't understand, and all this type of stuff. And he goes to the attorney, he goes, man, if you just get half of this back for me, or if you get this back for me, I'll give you half. I'll give you half. And they go, no, you're just a whiny, trader, and 300 grand down. So he actually has to borrow the money from his dad or sell one of his houses. He borrows it from his dad, gives the attorneys 300 G's, and they just think he's going to lose. And they have to go to an arbitrator before they go to court, as per the agreement, the fine print. And so this mutual friend introduces me. He says, Andy, you make this simple. Do you think you could talk to my attorneys? And I go, yeah. So I go down to Salt Lake City in the big building. Ray Quinney and Nebuchadnezzar is the law firm. And there's 2 attorneys and a paralegal. And I'm on my whiteboard explaining this. And all of a sudden the paralegal realizes that, oh my gosh. And I thought a light bulb would go off, and I said, all right, you come up here and got this mark, and you explain it to your bosses. And all of a sudden, you just saw these attorneys kicking themselves. In fact, they actually called Brett, and the guy's name was Brett, and actually said, hey, we'll give you back that 300 grand if you want us to go. They really did that. So anyway.
They wanted half of the
right.
winning. They saw the dollar signs.
They wanted me to testify in his behalf so I could explain this. There was a 3-judge arbitration panel before going to a thing. And he said, you got to come and testify. These attorneys did. I said, man, I'm going to London with Robert Kiyosaki. I can't do this. So I had a friend of mine who taught with me, and he went. And you'd think that, can you imagine Ameritrade, how they're lawyered up on this? I mean, they got lawyers like huge. And those dumb lawyers didn't understand it either. They didn't understand the trade. And that judge slammed down, those 3 judges collaborated, and they slammed down the gavel, and they said, Ameritrade, you owe this gentleman $7 million. And so that's kind of a fun story.
Yeah, that's crazy.
So yeah, as far as the question of, is it 1 trade? Is it 4 trades? Is it 2 trades? It's 4 trades. It's 4 positions in 1 trade, and the combination of those 4 positions is structured what we call an iron condor position.
Yeah,
so
and your broker
yes.
Nowadays, luckily, they don't have those issues. They link all of them
all.
together. You could do this spread like we've done. As soon as you do this other one, they know they're all Oxy options.
Never
they
a
all
problem.
get lumped together. You're good to go.
Never a problem.
Yeah.
But I told the story, Robert Ellingsworth, because I appreciated the question. But the computer it figures it out nowadays, so we never have to worry about it. It's solid. But in the old days, man, that tells you, I feel old telling a story like that. Do you remember Daytech, Corey?
I don't remember Daytech, but I remember a bunch of those old brokerages.
Yeah.
I used to use one called Realtic, and we thought it was revolutionary, and now I laugh at how many problems it had,
Yeah, Daytech got bought out by Ameritrade, and Ameritrade just got bought out by Schwab. So there you go.
Yeah.
All right. I don't know, maybe that's a boring story, but
no, I love it.
I'll tell you, it's the only time I've ever seen a guy win when he lost money in pseudo brokerage. I've never seen it nor heard of it ever, and in my life. And I just remember the look on those attorneys' faces when they're like, and he looked at me, the attorney goes, so you think we're going to win? Like, well, I don't know if you're going to win, but I know you're right.
Yeah.
I don't know if you can explain that, but yeah, he did not put that brokerage at risk. He had his positions where he had plenty of cash to keep all of his promises. He did not, there was no time where the brokerage was at risk to the point where they had to, shut him down because he was covered.
Yeah.
So anyway, interesting stuff.
Yeah, very cool. And you can see if we come back to this risk graph, I mean, you can see that max risk and max reward is defined. So you can't lose. In this case, we can't lose more than
yeah.
$1,800.
So,
and if we wanted to do it
right.
to where we did this side less, you could even do some things here where it's like we have 5 on this side, but maybe we only want 2 on this side. And so notice what that'll do in terms of skew.
$500 of risk.
Yeah. So now you still have the same risk over here, but you've got more, or pardon me, you've got less risk on this side.
Where we have more danger.
And of course, your total reward goes down because you didn't.
And that slides, and watch what that does to your price slice. Because of that, your break-even point on the top is going to move up. So now you got 67. So you can play with this stuff. How many things? Let me see. Are you supposed to become an expert in the Quick Start Lab today on anacondas? No. But are you supposed to learn general concepts to advance your education? Yes. Do I understand those 3 components? And as I move these things around, I'm seeing, we're changing the risk, we're changing the reward, we're changing the probabilities, as we play with this. You can't break a paper trade account. You can't break it. And one of the best things to do is say, okay, what did I learn? Risk, reward, probability. Go build some. Go build a ton of them.
Yeah,
go build as many as you want to. Pick a stock out of a hat. If you say, well, I want to do all 4 pillars, great. Do a fundamentals, do a technicals, do a cash flow, do a risk management, do them all. Or just say, I'm just going to pull 5 stocks out of the hat, do anacondas on, just work on the cash flow pillar for a while. Fine. Have fun with this. Screw around with this. Collaborate with your friends on this. And that's the biggest thing you can take from this is, okay, the more important things than the details is Andy and Corey said that the click of the mouse, think of how addicting this would be. Let's go back to the full iron condor, Corey, where they're matched up, the matching condor, where we got 5 contracts on both. Imagine how brutal this would be to a new trader to think, okay, for $1,800 in my account, I can make $600 on that in 6 weeks. And I can do it by clicking a mouse, and that money will be deposited in my account, that credit right now. That is so dangerous in terms of dopamine and epinephrine and whatever neurotransmitters are going on in the body. We've got to think the risk, we got to think the probability, we got to have exit. I think we'll talk about some exit next time. We'll talk about what happens when it goes to crap. And so don't ever be one of these guys, man. I mean, if you've got students in 108 countries, it happens about every other year. I get a heartbreaking email from a student. The most heartbreaking one I got last year was from a wonderful, kind woman in Canada who's retired, and she got into crypto. And she wasn't even a member of the Cashflow Academy. She saw me as a guest speaker on a podcast or something, and she just wrote me and she says, Mr. Tanner, you seem like an honest guy. I got in this crypto thing, and I gave him my whole life savings, about $100,000, because I heard crypto was the big thing there in London. And now they're telling me that the blockchain flagged my position, that I need to give them another $25,000 to unlock the blockchain, and they're asking me to go get a loan from my bank, and I'm just worried because that doesn't, that's just, I don't have that credit. She goes, can I just get out of this? And I just said, ma'am, do you have a daughter or someone that can kind of help you with this? She goes, she did. I go, can you get her? And I had to tell these guys, first of all, you didn't do a deal with someone in London. You did a deal with someone probably in Africa somewhere or in India somewhere, and you're never going to see that money again. And I'd be honest with them. So it's so tough when people don't respect the financial education and they get so excited to make the money that they don't take the time to go to the quick start lab like you guys did. You know, just to make me feel good, we charge about 160 bucks a month, and you know, how many are getting money's worth in risk education, just like in savings right now? You understand? It's so important to have experienced guys tell you about these risks, so then we can go for rewards. So let's put this one on, Corey. What do you think?
Yeah, let's do it. So we'll put this out there. I'll try to make sure that it executes. So you just come in, notice what I did here. I could just right click and confirm and send, and it says, okay, we're selling 5 verticals of the 70-75 March call spread for 65 cents credit, max profit. Now notice it's just showing the max profit and max loss for this side. It's not taking into account the other side because that was a prior trade that has already executed. It's just saying, hey, putting on this side will give you this much reward and this much risk. We know that risk is lower and we know the reward is higher because we already have the other side on, and kind of gives you the details there. We say, okay, great, go ahead and send. Because the market's closed, this order, of course, would just be pending and then working tomorrow as the market opens. And so it's kind of a rundown of the trade.
We'll see if we can get it for 65 cents with that limit order. If they don't give us that, then we're gonna readjust it and, you know, see what we can get. But these are invaluable things to have. And I'll tell you where I use these. These are not my bread and butters, I would say. I really like to write these. I've written a lot on like the Russell 2000 index, where I do it on a whole index. Gotta be a little careful. Those, they're cash settled, so you really can't, you know, if you like want to own the stock and you want to use the downside to get it cheap or whatever, they're cash settled. But these are fun when I see a chart or a temperament. I say, boy, there's some sideways stuff. Corey mentioned the technical analysis of the conversions of the moving averages. Sometimes you just see these and boom. Other people make a living in this. In fact, Corey, you ran a newsletter doing this on the S&P 500 for how long?
Yeah,
I mean, you did it like weekly. You would do one every week, and you used to
yeah,
write a newsletter. You want to talk about that for a minute? I mean, this is
we had
something
a
that
program that I developed. It was called the,
7
so
minute,
here's a little backstory. It's called 7-Minute Trader. And
used to be.
the funny thing about that name, so we kind of said, okay, we'll call it 7-Minute Trader. And the way we came up with that is we were saying it'll probably only take them from the time they get the newsletter to go in to their brokerage and place the trade about, 10 minutes. And then we kind of
Yeah.
timed it. We said, well, it's about, it was about 5 minutes for us. We'll assume it's going to take them 7 or 8 minutes. And
You're
if you've ever
killing me.
watched the movie, There's Something About Mary,
Yeah.
there was 8-minute abs, and he's like, well, I'm going to make 7-minute abs.
Oh my gosh.
And
Well,
so
at least you
that's why we
called it
decided.
that instead of beans and franks. Okay. I'm glad you got that right.
So that's why we
Not.
called it 7-Minute Trader, is because, well, 7 minutes is better than 8 minutes, right? And so, but anyway, we did 7-Minute Trader, and it was this SPX indexes. And what was interesting about that at the time was the market hadn't really caught on. This was years ago, and we could trade these index options and generate some pretty good income off of it. What happened, what's interesting is that in the years that followed, it became more and more and more popular as people saw that we were doing, not just us, but other people caught on and so on. And I shut it down. Heck, that must be 10 years ago. I shut it down because it got so oversaturated. And this
Yeah.
is a little something about this type of strategy is it did become a little oversaturated, and what that
Everyone was
does
doing it, meaning
is,
everyone was doing condors on the S&P. I mean, it was
yeah,
just everyone.
And here's the problem with that. So think about it from this standpoint. The options market is a market that there's what they call implied volatility. What options or how much volatility is being implied. But
Well, if you look
ultimately,
at the Vega, if you look over in the Vega column right there, you
yeah,
can see there's 24.2 plus or minus 106. This is
yeah,
all Vega stuff.
yeah. So the implied volatility is how much the option essentially is priced to move. This is the implied volatility that's being priced into the options.
In fact,
But
why,
think of
let
it
me
like
interrupt you, Corey.
think of
Go
it like
back to, go back
go
to
ahead.
Oxy. Let me interrupt you. Go back to
Yeah.
the risk graph on Oxy. This, I don't know if Interactive Brokers has this, but if you go back to that risk graph on Oxy, if you look, go back to the simulated trade, I believe is where we want it.
Oh, okay.
That simulated trade tab right there. If you go right dead middle, you go where the drop down is, there's a little yellow thing up and to the right, dead middle of the screen. There you go. It's called the MMM. It's called the market maker move.
Yep.
And what the Thinkorswim does is they say, okay, there's an earnings date coming up. Someone asked about that earlier, about the earnings date, right? Can't remember who it was, but I'll find it here. Someone mentioned it. I can't scroll. There's 1,000 comments. But in any event, I hate not being able to call someone by their name. There we go. Stephen Collins. Stephen says, what about the earnings day stuff? That's the market maker move plus or minus 74 cents. That's what they think it's going to be. Isn't that interesting? Plus or minus 74 cents is what they think that will be. So anyway, I didn't mean to interrupt you, Corey, but I thought it would be kind of nice since Stephen asked about the earnings date. That's when that little MMM comes up, and that's based on implied volatility. So there you go. Sorry, Corey, didn't mean to interrupt. Did you mute? Probably muted.
Oh, I'm muted. Sorry about that.
There you
Yeah,
go.
so if you think about how options are priced, that's great. Like they price in those events. They price in that earnings are out before March 17th. So that gets priced into the options, right? And so here's ultimately there's what the options theoretical value. In fact, you can even look at the theoretical price, what the option should theoretically be trading at, you know. And here's kind of a short way of explaining this. There's a bid and ask. Ultimately, that's where the option is trading, right? And so an option might be trading for $5 bid and $5.10 ask or whatever. So it's basically trading around $5 of value. But the question is ultimately, is that right? Well, in the time when I was trading short-term options in SPX, the options market was not saturated with those short-term option sellers. And so the premiums were at least fair value or maybe even inflated to what they should have been priced at. But what happens if everybody comes in and wants to be a seller of short-term options? It drives down the values. Think of it like this. This is probably the best analogy that I can think of right offhand. In Vegas, there's something, if you're looking at, and I'm not a gambler, but I know that in sports bets, there's what they call the over-under, right? And they say, okay, this team versus this team, statistically speaking, they should both combine to score 45 points. They can do the analysis and say, here's where this game should be priced. This is what it should be at. You know, Tampa Bay versus the Cincinnati Bengals, whatever. This is how much the two teams combined should score. They can do that analysis. That's what basically implied volatility is. But imagine for a second that for some reason, everybody's betting the over. Everybody just for whatever reason just keeps betting the over. Vegas is not going to set it at 45 because that's fair value. They're going to say, we're going to get so much action on the over that we have to give ourselves a margin of safety. We got to set the line at 50, and people would still come in and bet the over, even though it's way up there, right? in essence, that's kind of what was happening with options, with selling short-term options. Is I was betting the under. I was betting that the option would decay away and expire worthless. But if everybody else bets that those options are going to expire worthless, the options get priced lower and lower and lower because there's just so many sellers that the premiums go away. Exactly. So it became an issue that way.
And also, we had some times of prosperity where implied volatility dropped just in the nature of the S&P.
Yeah.
That the S&P became less choppy, and even the options by and large became, difficult. But you can always, adjust. So interesting stuff.
Yeah.
Okay, so what we're going to do next time is we are going to talk about, we'll check in on where this is, see if it got in trouble, but we're going to talk about how we get out of the trouble if we get into it. And since it's a paper trading account, I don't care to get in trouble, but you would not put it on. You would want to know, like, we want to look at this risk graph. I'm going to say, okay, what's our plan? And you'll see there's a time decay line in this. There's an expiration line on the risk graph, and there's a time line on the risk graph. So if we put it, that's not in yet, but you can see it's just fine. We can use that half. Yeah, there you go, analyze trade. So you can see the purple line is there's 2 red hash marks where it would be profitable, right? In between that. But outside of those red hash marks, we start losing money. And then you see 2 other red hash marks at the expiration line, value at expiration. And as time ticks by, you'll see that, as time ticks by, you'll see that get better and better and better and better. But even up until a few days before, you could still, be in a place where you could be losing money, right on the other side of what we call the theta switch. So where the theta starts working for you and then start working against you. So we're going to learn about, theta switches. We're going to learn about that blue time decay line, the purple time decay line. And we're going to say, okay, what if the stock pops up or even beyond that? What are you going to do? What are you going to do? And so position sizing will be important. Taking half off the table and reducing the position size will be important. Hedging, rolling up, rolling down, a lot of different things we can do with that. But we want to feel very confident in our education continuum that we have, a good level of proficiency in the risk management side of this. If the numbers are, now that's not, and oh, by the way, notice that the less time there is, the better probability we get. So probability gets better with time if it stays put. But if we go back to where we are, now we're really looking good. If we go back to today, at this probability, we certainly want to understand that, okay, where can I get hurt? Well, it's in the 16% to the downside, the 16% to the upside. So my plan should be, what if it starts heading that way? What am I going to do and when am I going to do it? And we should always never click the mouse hoping something happens, because that's your gambler. Then you just will play roulette. Well, I hope it doesn't land on green. Hope it doesn't. Well, if it does, you're dead. So you can't make an adjustment in Vegas once the wheels turn. Here we can make adjustments while the wheels turning. So that's the gig. The gig is how you adjust these when they go bad. That's the gig, right? That's it. So that's huge. Joe asked a question: how can you swing the premiums less than it should be? Meaning, when it gets saturated like that. Well, for me, and I'll let Corey speak to this too. For me, I look at a certain parameter that I like, and if I can get 10% of my money with 89% probability and 10% risk reward, I'm gonna make that trade. If it's less than that, I say, you know what, it's too saturated. So I have my own standard of what I want and what I'm willing to adjust to. I mean, after a while, if the premium's so low, it's like, it's not gonna work for this. Not work. Last question for you guys. Where we made an announcement, we've got a lot of people coming to Houston. How many of you've heard me talk about the Houston, you might not have caught last times and you're hopping tonight. How many do not know what's happening in Houston and how many do. So type in I know or I don't know real quick, so I know whether to spend some time on this or not. You're welcome, Joe. Joe just gave me a nice thank you. Okay, we got a lot of people that know, we got people that don't know. Okay, so I know, I don't know, don't know. I know, don't know. Okay. So for those that don't know, I'm not going to do a big pitch on this. There is I'm not going to explain it. We're having a meeting in Houston. First time ever, me and Noah and Corey are going to go. And I have a quick web URL if you want to check it out. I'm not going to talk much about it. And of course, I can't remember what the damn thing is. Hang on, let me bring up the email. Let's see.
I wish I could back you up, but I don't know it either.
Yeah, shoot. Hang on, link. That's not it. Okay, never mind. I don't.
Try follow Andy Noah to Houston.com.
Okay, here we go. Oh, here we go. I got it. Let me blow this up. I got it. You can go read about this at, and I'm not too worried about it because here we go. I'm not going to really talk a lot about it. I can't even. Oh, it's Let me have you do it, Corey. I'm dragging on my screen. They can't see my screen. TCFA is in Cashflow Academy. TCFA InvestorSummit.com. TCFA InvestorSummit.com. Those that know, and those that don't know, you do well to find out. TCFA is in the Cashflow Academy. TCFA InvestorSummit.com. And that's going to be a lot of fun. Oh, you got that. You brought it up. I was looking at my other screen. You got it up. So we got a couple of fun things you can read about, and you can go there and get information on. Okay. With that, great job, everyone. A lot of fun. Hope you can learn. Hope you learn some things. Jorge just put it in the chat for me to cut and paste it. He knows what it is. I hope you're learning big picture concepts and kind of gaining confidence that, you know what, I could play with this. I can start pushing these buttons. I can start moving it around. And that's as good as anything you do, because in a paper trade account, who cares, man? Have some fun. Any final thoughts, Corey? And we'll wrap this one up.
Yeah, just a lot of fun, so much education and discussion here that's worth review.
Really good questions. Compliment on everyone for their questions. Highly intelligent questions. Yeah.
Yeah. And we'll just continue to have fun with it. This is part of the learning process. I think it was great what Andy talked about as far as homework assignments. Go into your demos and just place a few spreads, place a few iron condors. You're not going to break it. Get some experience with it and just play around.
If you wanted to do one with a 90% probability, and maybe you're only getting 7% on your money, think about that. That's 7% in a month. So play with it and play with your own and follow along. Maybe you beat Corey and Andy. Maybe yours works out and ours sucks. Which, with as narrow as we are, that can very well be the case.
We've definitely got a narrow enough one that it's going to be put to the test. Let's say it that way, because it's not going to just flatline. The stock's going to move somewhere, and so even if it just moves a couple of points this way, it's going to start to put this one in a little bit of danger if it starts to move a bit this way, and it's going to do some of that. So we're going to have some good things to watch and play around with.
When you think about it, this is a $60 stock. We've got about a $20. 54 to 70, 16, what is that? $16.
15 bucks, I guess. 55 to 70.
$15 on a 60. I mean, that's a 25% move, right? Total. If you went from one extreme to the other. So cool. Okay. You're the man, Corey. You guys are all awesome. God, love these. So much freaking fun.
Yeah, and just
Ron knows I've got a cough. I'll get that thing worked out. I'm going to the pulmonologist next week, so we'll get that thing fixed. Figure out what's going on, man.
Yeah, and I put the TCFA InvestorSummit.com in the chat box, so anyone that needs that link click there, and we'd love to meet you in person.
Yeah, I'm going to stay on here a minute, Corey. Winton Williams had a question in. I'm not sure what. Can you clarify that, Winton? He says, Andy, I'm not given access, and if you're here in the room, I'm wondering what program you didn't have access to. So Winton, I'm going to chat with you for a bit if you can, kind of clarify that so I can get you some help. Other than that, guys, awesome. We'll see you next time. I think Noah is going to join us next time. So
Yeah.
First time ever Noah in the Quick Start Lab. That's pretty cool stuff. And Noah wanted to come. So it's going to be awesome stuff. So
It'll be fun.
Oh, Rui, when is the next one scheduled? Is it
next
Monday?
one is Monday. Monday looks like at 2:00 p.m. Eastern time, 12 p.m. Mountain, and so forth.
Yep. So 2 o'clock. We'll see you guys then. Awesome.
Bye, everyone.